Right. That's
Just give us our money back. Like, that's what that was,
why
right?
there was like like what Lehman Brothers and oh geez, some other financial firm. They got the rug pulled out from under them because they weren't playing ball accordingly. You know, because like you said, they call and they knock on the door, and you're not saying what they want to hear. Well, I'm sorry. It looks like you won't be getting the sweet bailout like all the other like Washington Mutual or AIG or what have you. No, play ball. Yeah, they got us
AIG
all by the balls.
insured all this shit. AIG insured all this stuff. They gave them default insurance. So the basic deal is like this, right? So they take 100 mortgages, that are out there that some bank is holding, or many banks, and they put them in a single legal entity called a collateralized debt obligation or mortgage-backed security. Now, because there's monthly payments coming in on these mortgages, right? That goes into like a pool, and there's stock. Like, okay, so you have this thing, this mortgage-backed security. It's a legal entity that's getting money from mortgage payments. Well, where does that money go? Well, they sell like a stock, like a share of that, right? So if you have an A grade, that means like if the thing defaults, they have a tiers of how they're going to pay people out. You buy AAA, AA, A, B, C, whatever. So the AAA, they're guaranteed to get paid, basically. Even if nobody pays their mortgage out of all those mortgagees, they're guaranteed to get paid out of the funds. And then it goes down the line, it's like what would they call it? I can't remember the name for it. Mutual liability or whatever. So like, if you're at the
it's
bottom.
like if you
Anyway,
have like
they filled these mortgage-backed securities with shit mortgages. Like people that had no possibility of paying. But the thing is, the reason they had no possibility of paying was this other thing. 3 years before it blew up, they were giving out variable interest loans with a teaser rate of 0%, right? And what they were being told was, when your rate balloons in 3 years, we'll just refinance you and give you a fixed rate mortgage. Okay, and your payment for that would be this. Well, when the 3 years rolled around, and you get after the 3 years are up for a variable rate mortgage, you have to make a balloon payment, and typically they're somewhere in the range of $4,000, depending on the price of your house. It can vary. So on the low end, say $150,000 house, you're gonna after the end of 3 years, you're gonna owe $4,000, right? Boom, you owe it. If you don't pay it, you're defaulting and you're screwed, and you're gonna take your house, right? So what happened was this what happened to a lot of people. They couldn't pay their mortgage payments. The mortgage-backed securities can't pay the people that they got stuff. But the thing is, these mortgage-backed securities had something called default insurance. So that if they got a lot of defaulters on those mortgages, that a secondary company like AIG that sold them the insurance, they would pay off that debt. They would pay all these people and basically say, all the money you're supposed to make off this mortgage-backed security over its lifetime, we're going to give you that money, and then you're going to take that money and you're going to pay off all the shareholders of that mortgage-backed security. Thing is, what happened is it was too much for a company like AIG or any other company to handle because it was billions and billions of dollars. So, AIG went down.
Yeah,
Lehman
it was
Brothers
literally
went
like
down.
$1 trillion. Like AIG was basically $1 trillion company. I'm pretty sure.
But I'll tell you the real reason the shit went down. Okay, so that's kind of like the mainstream version of why shit went down. What really went down is to transfer a mortgage, right? There's a legal process to transfer a mortgage, right? There's a note and there's the mortgage document. They were selling them as if they were separable things. So they would sell the mortgage to one party, and then they would sell the note to the other party, to another party. Now the note gets the income, right? So you have to pay, like, say, $300 a month. So the holder of the note gets that $300 a month. But if the person defaults, right, the mortgage is a security for that default. So whoever bought the mortgage has the right to claim the house. But the thing is, the law doesn't allow that. You have to have in order to enforce the mortgage, you have to be the possessor of the frickin' note.
Right.
So when all these places went default, and all these mortgages are in these mortgage-backed securities, they didn't have the notes. They'd sold the notes off to other parties. So you have Deutsche Bank, right? So they have a mortgage-backed security with 100 mortgages in it. They have the legal document that says the mortgage, but they don't have the note itself. The note that says, I promise to pay you X, the enforceable document to make them pay that money. So they have no legal right to foreclose on anybody, right? So this mortgage-backed security is garbage. And they've committed fraud because they didn't do all the legal requirements that all the people that bought shares, right? They say, hey, we have the legal right to all these mortgages. They never had the legal right to collect payments. Listen, they never had a legal right to even collect the payments. You could have seen they're getting paid for nothing. The notes themselves were being traded and bartered and used as collateral, because you can take one of these notes and you can give it to the Federal Reserve's discount window and get money for it. And then the Federal Reserve takes the note and sticks it in what's called a borrower in custody program. So they basically use that note as collateral, stick it in a drawer, right? And then they basically exchange. It's called a discounting a note, right? So you have $100,000 note. They say, hey, that note is worth, not $85,000. So that that's called a 5% discount, right? So they give you $95,000. They're going to keep the $100,000 note. At some point in time, they want you to come back. It's almost like a pawn shop. You're supposed to come back, give them the money back, and then they give you the note back. So this particular action, right? Dude, I'm giving you like the fucking whole deal, dude. So this particular transaction, right? The Federal Reserve is legally allowed to print new money for residential 1 to 4 family residential mortgages, right? So they have specific things from which they can print money. They got to have gold certificates, special drawing rights, or U.S. Treasury bonds. But in 1999, they added mortgage-backed security, or not mortgage, residential mortgages to it, that they can print new money, right? So if they want to print the dollar bill, they needed to have a dollar bill, or $1 worth of gold, or $1 worth of Treasury notes. In 99, they changed it. Well, they can have $1 worth of residential mortgage note, and then they can print new money. That's as in print new money and put it into the system. So that's what the Fed was doing on their end. So you had this clusterfuck of a bunch of financial frauds all happening at the same time. The Fed's committing fraud, right, by not making sure that the mortgage is with the note. You have people splitting the note, which isn't really fraud, but it's when you say that it's worth something and you sell it to somebody and it's actually really worth nothing, because if you don't have the note, the mortgage is unenforceable. That's been the law for fucking 500 years. 500 years that's been the law, and they did this shit. They also created this whole other system called the mortgage electronic registration system, where they assigned notes improperly, right? So nobody knew who fucking owned what. Dude, it was a total clusterfuck. And basically, it was like this. The bank doesn't know, when it looks at its assets, it doesn't know what's worth anything. All these banks. They did not know if they owned a mortgage-backed security and if it was worth a freaking nickel. They looked at their mortgages that are on the books. They don't know if they're worth anything. All their assets, their capital assets, for which they can use the fractional reserve lending system. So you got to have so much capital assets to get so much money. So 100,000, you do 10 times that, and from the Fed get actual cash and operate your bank, etc. Give out deposits, whatever you want to do, make loans. But they didn't know what their assets were worth. Nobody did. So you're in a market where the whole market for this paper product, this mortgage market, nobody knows what anything is worth. They don't know if, like, that mortgage, right, if there's a note with it, or fucking who's paying it, or did I assign it to some other party, and do I have insurance on it? Is that insurance company that's for that default, are they even going to pay? What do they own? Like it's called counterparty risk. you have an asset where someone's promising to pay you money, but you don't know if fucking they actually have a legal obligation to pay it because your paperwork's all fucked up. And every bank is in this same situation. Every investment bank is in this same situation. They're all in this fucked situation. The government basically had no choice. Basically said, to remove uncertainty from the system, we're going to give you basically all the freaking money that you're uncertain about, right? And you're going to just freaking write off that other shit and pretend that it fucking doesn't exist. But they didn't do that. What they did was they started doing foreclosures through the system, right? And like most of them worked because most people, when they didn't pay their mortgage, they were like, "Oh, I didn't pay my mortgage. I'm just moving out," and the bank would just come and repossess the property. They wouldn't like fight it in court and say, "Hey, where's the note for the mortgage? You can't enforce you can't take my house unless you produce the note," because they're supposed to. When they go into court, they're supposed to bring the note is part of the evidence that you owe them money. They're supposed to go in, enter the note into evidence, and not a copy. It has to be the original, and they're supposed to cancel the note before they seize the security. Because otherwise, they can, if they don't cancel the note, it could be put in circulation, and that person would still owe money, and he wouldn't have any legal defense because the note is still in circulation, and he signed the note. Note is like I've explained this before, a specialty contract. So there's only a certain number of legal defenses. Basically, the only one is someone forged my signature. That's your only like legal defense that you have that says I don't have to pay that. There is no defense like, oh, someone sued me on that note and they took some security and I don't have to pay it anymore. No, you're still going to be personally liable for that note unless it gets fucking canceled with words canceled on it. So the bank they got that money and they still tried to collect that money that they were uncertain about that they owed. So it's a big total clusterfuck. And that's basically the mortgage fucking crisis in a nutshell.